Hi, welcome to Feel the Boot. I'm Lance, and today I want to talk about how to decide how much money you should raise in your funding rounds. I talk to a lot of founders who are trying to decide how much money they should raise, particularly in their seed rounds. And it's really a dilemma between two different issues. On the one hand, they need enough money to grow the business and to achieve their milestones. On the other hand, the more money they raise early on, the more dilution they experience, and so the less of the company they end up owning. And often they become very concerned with that issue. They get obsessed with not raising too much because they're afraid it will shave a few percentage points off their final ownership. In many cases, this leads founders to raise less money than they really should. They need to have some runway for the business. You don't want to spend your whole life on the fundraising trail. You want to get the money in and then actually spend all of your time and attention executing on your plan before you have to go out and raise more money. One reality that I often don't see founders taking into account is just how hard it's going to be to raise that next funding round. They assume that, okay, I've got 12 months of runway, so in 9 months I'll start fundraising and I'll have the money at the end of the year. But probably it's not going to work out that way. I see a lot of companies that are going a year or two of continuous fundraising to close that round. So it's taking much longer than expected. And if you're going out for an A round, they're now wanting to invest big bucks. So you're not going to be able to get a modest A round at a modest valuation. You need to be able to get a big A round at a high valuation. And of course, that comes with high expectations. You need to have achieved a lot. You need to have proved out many of your assumptions and have real traction and have real customers and revenue. But based on the seed round, you probably aren't going to be able to get there. So I see a lot of companies ending up doing multiple different seed rounds. They're doing continuous closes on bridge rounds before they can get to that A. So they're spending a lot of time on the road. They really probably would have been better off if they'd raised more money right up front. Get the cash in, focus on the business, hit those milestones, and then be far better positioned to go after that big round. And if you've got enough runway, you've got the time to actually do that, even when things go slower than expected. And I think that's a whole nother cast, but always things go slower than expected, even when you take that into account. One of the most important things is that when you get to that next round and you're negotiating with the investor, you can't be broke. If you're over a barrel, you're gonna get screwed. That's a terrible place to be. If you absolutely have to have the money, they have all the power. And you're probably gonna get crushed in some kind of a down round because they know they can do that to you. So you wanna make sure that you still have dry powder. You have money in the bank and runway when you're raising that next round, because that means you can walk away. And any negotiation where you can't walk away really isn't a negotiation anymore. As an investor, I actually worry when I see a business not raising enough money. I'm concerned that you won't be able to actually hit your milestones and prove out the next phase of your business growth before you need to raise more money. And that's going to cause problems for me. There's a couple of bad outcomes. One, your company could just crash and burn. That's not good, right? I've now lost my investment. Two, you may be coming back to me over and over with your hand out saying, can you please feed me a little more money? Can you give me another bridge? Can you keep me going? And if I don't want to lose my investment, I'm having to keep writing checks under duress. I don't really want to invest in the company at this point, but I feel that I have to hold on to my investment. And that's not a comfortable situation. I really don't enjoy that process. Or finally, you're going to get into a situation where you don't have the negotiating leverage and you're going to suffer a down round, and then I'm going to have my investment substantially diluted, and that's also bad. So I want to make sure that you, as a founder, are raising enough money to get to that next round in a good position, having demonstrated all of the milestones you set out to, so you can get the kind of valuation that'll make all of us happy. So at the end of the day, the advice is pretty simple. Try not to get too hung up on the exact amount of dilution and raise more money than you think you're probably going to need, because it's going to be harder to raise, it's going to take longer to do that fundraising, and it's also going to take longer to hit the milestones than you probably suspect. So having that extra cash on hand means you'll be able to weather those comfortably to get to that next round. And at the end of the day, that's where the success comes. The growth of the company is really what matters. You want to own maybe a slightly smaller piece of a very large pie rather than the majority of a really small pie. Thanks for watching this episode. I hope you found it useful and interesting, and if so, I'd like to ask you to do a couple of things. First, the usual, I'd like you to like, subscribe, and hit the bell. But I'd really appreciate it if you would share this content with other founders. I advise a lot of people, but I don't scale well, and this channel is how I'm trying to help more founders. This is really my personal passion. I'd also love to hear from you what topics you'd like to see me cover. Let me know down in the comments. Till next time, ciao.